Sound money versus the endless debt machine. Grab a coffee or whatever you're into, because today we're going on a journey into the heart of something that touches every part of your life, whether you realize it or not, the very nature of the money we all use every single day. It's one of those topics that feels dry on the surface, but once you see what's really going on, it changes how you view work, saving, the future, and even freedom itself. Let me give you a little teaser. Imagine for a moment that the financial system we've all grown up with isn't quite what it seems. What if the money in your pocket or on your screen is actually something else entirely, something fragile by design, built on promises that keep piling up in ways that quietly reshape society? Stick around, because by the end of this, you might look at your bank balance a little differently and start asking some big questions. Before we delve further into this exploration of the monetary system, allow me to offer a brief reminder. If any part of this discussion resonates with you, perhaps a striking insight or a moment of clarity, please consider liking, commenting, and sharing the episode while following for future updates. Alright, let's pull back the curtain. And yes, this is the part where things get eye-opening. At its core, the modern monetary system operates as a vast network of debt. Money isn't mined or grown or produced through real effort in the traditional sense. Instead, it's created through lending. When a bank makes a loan, it doesn't hand over existing funds from somewhere else. New money literally comes into existence as a deposit in someone's account, matched by a corresponding debt obligation. The central authorities do something similar at the base level, swapping claims with commercial banks. It's essentially IOUs being traded and labeled as money. Think about that logically. Every unit of this currency enters the world with a twin, a debt that needs to be serviced, usually with interest. It's not backed by a fixed tangible thing with its own intrinsic limits. This setup allows for flexibility, sure, but flexibility cuts both ways. And here's where reason kicks in against the common idea that this system is simply modern and efficient. If every piece of currency requires debt, and that debt carries compounding interest, then the total amount of debt in the system must keep expanding just to pay the interest on the old debt. Where does that extra come from? More new loans, more new money. It's an engine designed for perpetual growth in the money supply, not because the economy always needs it, but because the money itself demands it. Now, let's unpack the bigger themes and what this really means for all of us. Because this debt-based creation isn't neutral. It sets up powerful incentives. When new money flows in, it doesn't spread evenly. It tends to chase returns in financial assets first: stocks, real estate, bonds, inflating prices there before it trickles into the real economy of goods and services. This creates bubbles. Not occasional accidents, but a recurring feature. Prices get bid up on speculation, not always on underlying real value or productivity. Then, when the music stops or rates adjust, those bubbles deflate, leading to contractions, lost confidence, and pressure for more intervention, more liquidity, more debt to fix the previous excess. Over time, this dynamic concentrates gains in the hands of those closest to the money creation process or those who own the appreciating assets. Meanwhile, the people producing actual goods and services, working hard day in and day out, see their wages lag behind the rise in asset values and living costs. Productivity in the free market has soared in recent decades thanks to technology and innovation, yet the purchasing power gains for the average person haven't kept pace the way they once did under systems with stricter anchors. The extra value has been captured in financial claims that compound over time. It's a silent redistribution, not through overt policy in every case, but through the mechanics of how money is born and flows. Compounding interest supercharges this. It's not just simple interest on one loan. It's interest on interest across the entire global debt stock, which now dwarfs annual economic output by a huge margin. Logically, if the real growth rate of the economy can't consistently outrun the effective rate on all this debt, the burden grows exponentially. Servicing it requires either faster real growth, higher inflation to erode the real value of debt, or ever more borrowing. None of these are sustainable forever without consequences. Inflation, in particular, acts like a hidden tax. It quietly reduces what your savings can buy year after year without you ever voting for it. Some argue the system allows the free market to expand more dynamically, but reason shows it actually distorts the free market by encouraging malinvestment, pouring resources into projects that only look profitable because of artificially cheap credit. When reality reasserts itself, the correction hurts more because the imbalance is built up so large. Compare this mentally to sound money, something scarce by nature, like a precious metal with a long history as a reliable store of value. Under such a system, the money supply is constrained. As productivity rises and more goods become available, prices tend to gently fall over time, rewarding savers and making planning easier. The purchasing power of your holdings can actually increase. There's no built-in need for constant expansion or bailouts when things wobble. The discipline comes from the money itself, not from promises or political discretion. Emotionally, this hits home when you think about families across generations. Parents and grandparents who worked their whole lives expecting their savings to provide security in old age, only to watch inflation eat away at that security. Young people today entering the workforce, facing higher costs for housing and essentials while feeling the deck is stacked toward those who already own assets. It's frustrating because it feels unfair. You play by the rules, produce value, Yet the system seems rigged to siphon real wealth elsewhere. This isn't about envy. It's about recognizing a structural flaw that undermines trust and the true rewards of effort in a free market. One historical figure from the world of finance put it starkly back in the early 20th century during testimony about banking. Gold is money. Everything else is credit. That line cuts through the complexity. Credit has its place. It greases the wheels of commerce. But when credit is mistaken for money and allowed to multiply without limit, you get the illusions and instabilities we've been describing. So where does this leave us? The recommendation isn't panic, but awareness. Take the equivalent of that red pill moment, question the matrix of assumptions we've all absorbed about what money is and how the system has to work. Educate yourself on sound money principles. Consider holding some portion of your wealth in assets that have stood the test of time as honest stores of value, not dependent on endless debt rolls or central promises. Support ideas that bring more discipline and transparency to monetary affairs, because a sound foundation benefits the free market, innovation, and everyday people far more than any short-term stimulus. Ultimately, understanding this empowers you. It shifts you from being a passive participant in a game whose rules favor perpetual expansion and hidden transfers, to someone who sees the game clearly and can make better choices for yourself and your family. The system isn't eternal or inevitable. History shows monetary arrangements evolve, often when their internal contradictions become too great. By spreading clear thinking and demanding better, we move toward a world where honest effort and saving are properly rewarded again. Thanks for joining me on this deep dive. If it sparked some thoughts, share it with someone who might benefit. Keep questioning, keep learning, and take care out there. Stay wealthy, stay free,